Welcome to How I Raised It, the podcast that goes behind the scenes with entrepreneurs who've raised capital. We uncover the tips, tricks, and techniques they use to get investors to write a check. Strap in and turn it up.
Hi, and welcome to another episode of How I Raised It. Today with me is Rod Reason of Springbuk, coming to us from Indianapolis, Indiana. How's your day going, Rod?
Fantastic.
Great. Are you guys in the throes of winter still, or is it starting to be springtime in Indy?
It is nearing spring. No buds on the trees yet, but it is in the mid-60s. It's a nice day here.
Nice. Awesome. So we start off with the easy ones. What is Springbuk and why did you start this business?
Oh, wow. So Sprinbuk is a software built to help employers identify opportunities where they need to invest in the health of their population. We have a big vision to prevent disease with data. My background, I came out of the brokerage industry and would work with employers developing pivot tables to understand their data. I was really frustrated with the time, complexity, errors that could be created using Excel just from humans, and felt like there was a real opportunity to create a lot of automation and bring sophistication down to a simple layer using software to do it.
So give me an example of maybe almost a customer case study of how this is implemented and what it does.
Yeah, well, I'll give you several hard examples. One of the issues that you run into with employers that have huge or high turnover is that if you have a really sophisticated HRIS system or a good team working with it, organizations offload their employees off their insurance pretty quickly. Typically, the first place that an organization does that is with payroll. Logically, they stop paying people that don't work for them any longer. But sometimes what's missed is other systems or things that they're on, and insurance could be one of those. So with a trucking company, we found there was an organization that had a high turnover, about 100% turnover every 6 months in their truckers. And we tracked those that had been terminated from employment through turnover. And then we looked at the medical claims and found that there was $387,000 in excess paid medical claims to employees that were no longer working at the employer. And that's just a hard, real simple one that happened just simply because an employer forgot to terminate them off of their medical plan. There are other better examples, but that's a real easy one just to look at to say, gosh, software should have caught that. A human didn't. So systems can be put in place to solve for them.
Okay, interesting. So you were in the brokerage business, you said. How'd you get into this? Where'd this idea come from?
Yeah, no one ever sets out to be in insurance. That's the big joke about those that do end up there. So while I was in college, I owned my first mutual fund when I was 13. My dad was a factory worker. I grew up in a very blue-collar family. Mom sold Avon. Dad worked at a manufacturing plant lifting old picture tubes back when TVs had these big glass picture tubes inserted into these wood cases. And my dad was one of those guys. So at 13, I remember back in the day, it would have been in the mid 90s. I was getting Fidelity, Thompson, other investment prospectuses sent to me at 13. So I bought my first mutual funds at 13. So I had a lot of interest in the investment world. My dad was focused on sending my brother and I to college. And that kind of led to getting into financial planning. Ultimately, out of school, worked with a lot of high net worth individuals that owned businesses and some doctors. And eventually, one of my larger employers who I had was working on their 401k plans said, "Can you help us with this insurance stuff?" And I said, "Heck no, I'm not an insurance guy. Those guys wear plaid jackets and they just take commissions." And I didn't understand the space well enough, but definitely did not feel like I wanted to be an insurance guy. And finally, I had several customers on the 401k side saying, "Can you help me with this?" And I said, "All right, I'll take a look at it, but I want to charge a fee to do it. I don't want to be paid a commission." And remember, one of the very first customers that we looked at was a restaurant business. And I said, give me all your data. I'll take a look at it, and then I'll come back and make a proposal. So I did that. I found that they were paying almost $280,000 in commission to their broker via their documentation that they gave me. And I said, I'll tell you what, I think based on your based on the analysis that I've done, I can save you $1 million by doing some changes within your benefit structure, and I'd like to be paid $150,000 for my fee. It took me almost 30 minutes to convince this particular customer that they were actually paying $280,000 in fees via commissions to their existing broker. But once we were able to get past that, and then seeing the light kind of go on, so to speak, in their heads, it was like, there's a real opportunity to come into this space and disrupt it. So entered the brokerage industry, learned a lot, and the whole industry went through massive changes. Most of the brokers, consultants in the space today, which we work with a lot of them, they're far more transparent. The relationship is more pure, and we just felt like that was a real opportunity to change the dynamic, the economic relationship, and then ultimately to be able to help the employer drive down cost.
Okay, that's interesting. That's pretty fascinating how I love the background story or origin story of startups. It's always pretty interesting. When I was in college, I interned at Solomon Smith Barney, a retail brokerage, names that don't even really exist anymore, right? I mean, it was a big retail brokerage house, and it's gone. And then I worked at Arthur Andersen, and that name's gone too. That's kind of funny.
Yeah.
Very interesting. Great. So how did you start this when you were starting out? Did you fund it through your own savings, or did you raise an angel round? What was the initial foray?
Yeah, so we, through my brokerage firm, we were going through this transition, trying to understand just the innovation that was taking place. So to time date stamp that would have been, started that brokerage firm in 2002, kept the financial planning firm. And then, so from 2002 through 2008, the market dynamics were changing dramatically. And not to talk politics, but to look at the political landscape was changing very dramatically with the onset of the PPACA. And so I took a real hard look at the space. We said, we need to innovate pretty abruptly. There were a lot of acquisitions taking place. And we dreamed up this idea of, what if we were able to collect the largest set of wellness data in America? And at the time, in the late 90s, early 2000s, wellness was still pretty vague. It wasn't called pop health or population health management. Those words have now migrated. And we said, there's an opportunity here to understand what's taking place, but in a holistic fashion, put on a pedestal those companies that are doing really good things. So we dreamed up this award program called Healthiest Employer Awards, and that was in 2008. 2009, we launched the award program with the Indianapolis Business Journal, and within months, we started getting calls from journals across the U.S. saying, hey, this is a really good idea. So pretty similar to the Best Places to Work type program, we partnered with a local entity, and we did these Healthiest Employer Awards from 2009 through 2013, and we still do those award programs. But it was that time frame that we started to see that employers have, like Malcolm Gladwell's tipping point, employers have gotten to the point where they're beyond frustrated. They're now looking for solutions to drive down healthcare costs, and they're just throwing stuff at the problem. And we said, holy cow, anytime you see a market moving and you see the buyer ultimately frustrated and they're continuing to throw solutions at it without the ability to track results, that says opportunity. So we took a big pause, sold the brokerage firm in 2010, and I spent almost 3 years on the road using my own money from that sale to investigate the industry.
Fascinating. Okay. So then 2013 is when Springbuk was founded. Is that correct? Somewhere around there?
So, well, the seed, that little idea kind of popped in our head in mid-13. We had surveyed at that point about 8,000 employers, 7% of the Fortune 100. I had the privilege to go out and meet with Nike, talk with some of the folks at Dell, Procter & Gamble, General General Mills, and others. So some large organizations, and said, this idea of healthcare, PPACA is coming down the road. And at the time
What does PPAC stand for anyone?
Oh, sorry. Yeah. It's basically the ACAs or the ACOs that we know about today, or ACA and ACOs. So it's the healthcare. Obamacare would be the term that your listeners
Okay,
might.
gotcha.
So Obamacare was. We'll just use that language to help the listeners here. But that was still going through legislation and implementation, and employers were at the stage of trying to figure out: do they want to continue offering healthcare, or are they going to pull out of the industry completely? That was what was happening at the time, and so we said that there is a massive opportunity. Employers are not going to; those that had pulled out of the offering healthcare coverage are now coming back that direction because it's still an expectation by the American worker. Mm-hmm. And so if they're going to do healthcare, and that's what we had seen from these larger employers, if they're going to be involved in it, then how are they going to control the increase in healthcare cost?
Okay. So you started this, let's get into fundraising details.
Yep.
You started this in 2013, you raised a seed round at that time, or an angel round? Or was this still purely bootstrapping out of your proceeds from the brokerage sale?
Yeah. So 2014 would have been the first time we started to take on investment capital, where we took this seed into an MVP and started to bring on angel investors. Mm-hmm. We got it to that point near the end of 14, and then took the product live January of 2015.
Okay, great. And that the seed round, was that just friends and family, or is that angels from the Indianapolis community, or what?
It was all angels from the Indianapolis community.
Okay. Is there a pretty established angel community in Indy? Is there an angel, one of these angel groups that hold regular meetings for pitching? What's the angel scene like in Indy?
That's a good scene. Indy's been on the latter stage of some very successful tech companies and exits. So there's been some watershed effect that's happened here. Because of that, there were some recent money by angels here locally. It has a really good tech scene, an incredible tech scene. So the angel community surrounds it and supports it. So there's lots of various events that you can go to and pitch. Plenty of opportunity to practice.
Yeah. Great. Was there a company or two that went public in the last 10 years that threw off some angel investors? That's often how it starts, right?
Yep. Yeah. The two big ones were Software Artistry, and then the most recent would have been Exact Target. I guess the most recent would have been Genesis, but at the time, they were Interactive Intelligence, which was bought by Genesis. But at the time, it was Exact Target, who had gone through the IPO stage, massive capital inflections, big name VCs coming into the state. They grew, did their IPO, and then within a year were acquired by Salesforce, which is now the largest building here in Indy.
Oh, yeah. Interesting. Is there kind of an Exact Target mafia? Like you see a lot of these, I had a call last week with a guy who was talking about the HubSpot mafia in Boston, right? A lot of...
I don't know that these guys in Indiana would call themselves the mafia. It's probably not a term that we use here locally, but there's certainly a contingency. In fact, I met with one of the guys this morning. Really supportive, good Indiana folks, willing to roll up their sleeves, help entrepreneurs. So, and I think that's what you hear in other local communities is these watershed effects create events for other local entrepreneurs to attach and learn. So yeah, certainly Indianapolis has a pretty good scene of those folks.
Is there part of the reason I'm asking this is just to give folks who might be in Indy who are looking to raise their seed round some resources. Is there an established angel group? Like here we have Sandhill Angels, Band of Angels, things like that. Is there a Indiana Angels group, or what are they called?
There's a Vision Tech Angels, which is one. In Indiana, there is a group called Elevate Ventures that it's not an angel group. It's actually state funding or state money that's put into an organization managed by a local organization to invest in Indiana companies. And there's Indiana state tax credits available. I don't know if this is appropriate to share. You can tell me to stop if I share too much. But in Indiana, if you're an Indiana company and you're an Indiana investor, you can get up to 20% tax credit for your investment in an Indiana company as a qualified Indiana tax-paying resident.
Okay.
That was actually very beneficial for us when we were doing our angel round, which was predominantly from Indiana. residents. So $100,000 investment, in essence, if you're in that taxable band, would only cost you an $80,000 tax equivalent. So it de-risks some of the investment for the Indiana taxpayer, and that obviously helped out the entrepreneurs too.
Interesting. Great. Okay. One more question about your seed round, then we'll move on. Did you already have a network of folks that you, maybe from your clients in the brokerage, that you were hitting up to invest, or did you search on LinkedIn for exact target VP and reach out to those guys? How did you kind of gather that angel round?
School of Hard Knocks. We literally just opened up the Rolodex and started calling people. Interesting. I did not go to any of my past investment customers, primarily because of SEC filings and just confusion. And so we steered away from that network. We used them as a network to find other folks that we might know, but none of those customers were ever involved. So we did not have a network of folks that we knew. I was a brokerage guy coming into the software space, so I didn't know a lot of people in the software industry. So there was just a lot of hard work. Roll up your sleeves and start networking.
Yeah. Okay. Great. Let's move forward a little bit to the Series A, which, as my records say, was Elevate Ventures, who you just mentioned as the state fund, and Lewis and Clark Ventures. Let's maybe, excuse me just a minute. Let's touch on this. Elevate Ventures is the state money. So do they act like a traditional VC in how they're screening deals, or what's the, what's the play there?
I would call Elevate Ventures a mild VC, and hopefully they won't be offended by my stating that. They do act like a VC, so you go through a qualification period, a presentation. In many ways, you'd almost think of them for a Series A investment as a little bit more stringent than a traditional Series A investor, because they're reporting to a government entity. They have a lot more things that you have to go through, or hurdles that you have to jump through. I think that can be good and bad. It slows them down. So if you're a really high, attractive, fast-moving company, sometimes they miss out on deals, and they know that. Yeah. But it also helps entrepreneurs to go through a process that they'll ultimately have to prepare for, to seeking out a more traditional VC, or then moving into a B round at a later stage. So I think it's a good way that their structure is set up.
Do you know how big their fund is, or how much capital they have?
I do, but I'd be guessing to say the exact amount. But okay. It's a pretty good sized fund.
And is there criteria? Because this is interesting. I think you're the first guest I've had that has pitched one of these sort of state-sponsored funds. Is there mantra to create jobs? I mean, is that kind of their charter, so to speak?
Yeah, I mean, in essence, that's the primary driver, is to keep Indiana entrepreneurs in Indiana and to support them here to be able to have job growth and economic improvement or development through innovation. So it's not just a piece of it, but it's also to make sure that Indiana tech entrepreneurs don't leave the state and go seek money in Silicon Valley or anywhere else, that they can be funded in that state and not move. Because if we get funded somewhere else and then move operations, the likelihood of coming back to a state, wherever it is far more difficult. So yeah. I think their mission is really, really well aligned.
So any tips for pitching a state entity like this? Obviously, was it a legal requirement to stay in Indy to get their money? Does the pitch change if you're pitching a state money, basically?
I don't know. We did not change our pitch to be specific for any one entity per se. I do believe that there are some requirements. You have to be in that state for a certain, or at least in Indiana, for a certain period of time, or a number of jobs that you have to produce in that state. So they certainly wouldn't have approved us raising the money here and me and my co-founder staying here, or having a post office box address, but then hiring all of our people out of state. That would kind of be misaligned with their intent.
And then the other investor was Lewis and Clark. Tell me about them. I'm not familiar with them.
Yeah, so Lewis and Clark, the managing partner there is Tom Hillman, and Tom is you would call him a luminary or legacy internet player. He was one of the founders of Hoovers.com, Answers.com, and so very successful entrepreneur. He's part of over 50 businesses, runs a PE firm out of St. Louis. He's a big name in the Midwest, in St. Louis specifically. So one of their partners was in town, called me up, and a little bit of the joke was he sends you an email, and you're for all these entrepreneurs that are talking, they'll appreciate what I'm saying. Sends you an email on a Friday and says, I'm going to be in town on a Tuesday or on a Saturday afternoon at 2:00, and you're like, a Saturday afternoon at 2:00, and I'm going to be downtown, which is about 40 minutes from your house. Do you want to meet? Well, every entrepreneur is like, yes, respond to email, of course. But you're thinking, really? You picked a Saturday at 2:00?
Yeah.
So that was our first meeting.
It's a test. It's all a test, right?
It's right. It's right. It must be.
Saturday on afternoon, and that's great. Was it at his office, or was it at a sports bar or something?
No, we met at a hotel. He and his wife were doing some event, and we met at a hotel prior to the event.
How did you get in touch with him? Sounds like a good guy to know.
They reached out to me. So we, as is part of our story here, they reached out to us. That serendipitous.
They saw you. How'd they learn about you?
The gentleman that reached out was Ron Watson with Lewis and Clark, and he happened to be from Lebanon, Indiana, and he was back in town for some, and he was looking for Indiana companies that he could potentially look at to add to their portfolio, and we were found.
So let's talk about that, because I think that's an interesting little tangent we can go on of, it's always better if investors are coming to you, and some of the most successful companies have a lot of inbound interest from investors. I mean, did you work to create a buzz about the company as sort of a emerging player in the indie scene, or literally this is just you got really lucky?
This is a bit unlike me to even do these types of phone calls or to be on a show like this. We're very much under the radar. We tend to believe let our actions be our proof, not our marketing. And so, no, we had not done anything. I mean, we had networked with folks. We had gotten Elevate Ventures to get interested in us, and I think he had reached out to Elevate, and Elevate had referred them to us. So, no, it was not an something outbound that we had done, at least in this Series A. I'll talk different about that in the Series B, because I think it was a different strategy.
Okay, just one more question on Series A, and then we'll go to Series B. But how many investors did you talk to during Series A, and was it all indie-focused VCs, or did you look outside the state? Give a little color on that round.
Yeah, we did go outside the state for the Series A, but we didn't do like coast. We did talk to a handful just via phone, but we were really looking to stick pretty close and keep it tight to the vest. We were pretty confident that we were into a marketplace that could be $1 billion market at some point, and there is some thesis, at least it was ours, that you go find an investor that believes in your thesis. Join hips with them, and they'll help you get to that next stage. But try to keep it under the radar as much as possible. So that's what we did for our Series A. That did entail, we went to Chicago. We went to several conferences in Chicago. We won several pitch contests that weren't worth anything, big prizes that weren't actually prizes. And I'm sure anyone that's still listening would say, yep, been there, done that. Even done the 60-second pitches. Those were just quite fun. So we pitched all over the place. Any place we could find in the Midwest was within driving distance, we would go pitch at, and learned a lot about our presentation style, who was interested, what kind of investors we were really, really interested in. And then ultimately, Lewis and Clark, emails us, and we literally hadn't even talked to them. So that was really, really kind of fun.
Cool. Did Lewis and Clark lead the Series A, or was it Elevate that led it?
Lewis and Clark, yeah. Lewis and Clark was the lead on the Series A.
Cool. Great. Okay. Let's. Oh, one question, if you're willing to share. What kind of metrics did you have at the Series A? I think it's interesting because I'm talking to people on this series from Silicon Valley, but also from Wisconsin and Dallas and Vancouver, and it's always kind of interesting to hear different markets or fundraising is almost kind of local in many ways in terms of what local investors want to see in terms of metrics, revenue, stuff like that. So are you willing to share any metrics of what you had at the Series A?
I'm not sure. I'll answer maybe two different types of metrics. I mean, we were looking for a relationship, not just capital. So obviously capital gives us the fuel, but we weren't just out seeking someone that could put money in our bank account. We were really looking for the right partner. And so we had a lot of investigative work on our own that we did. Even when we would get an email inbound to us, we would do a lot of research on an organization before we would even respond to an email. Even the Lewis and Clark, when they responded to us initially, they were just starting their fund. It was a big fund in the Midwest. We looked at the backgrounds of their founders, we looked at their management team, and we said, okay, this is an organization that is software oriented. They're willing to roll up their sleeves. So from that side of it, the metrics were more from our internal looking outward at a potential investor. But as far as an organization, absolutely. I mean, we're CAC driven, LTV driven. We're going to look at all the major SaaS metrics that any organization would look at. At that stage, ARR was the main driver because we're still pre-Series A. So we were creating revenue. We were close to $1 million in our first year. We were more than doubling revenue in that second year and on track to do even better. By all natural SaaS metrics, we were an attractive organization to be investing in, and we were tackling a massive market with two major legacy players. So we had all of the hallmarks of an organization interested in at least speaking to.
Yep.
And so then we just had to do everything else right. Show up to meetings, prove that you're trustworthy, honest, high integrity people, prove that you have a way to go after the market. So.
No, that's great. That's great. I like it. Okay, let's jump ahead then to the more recent round, which, let's see, when you just closed it, correct? On the Series B, the $20 million Series B?
We did, yep.
Congratulations. That's pretty exciting. Tell me about this round. How did you go about raising this round? I noticed 4 investors on this one. And then, kind of maybe any differences in how you ran this round versus your Series A.
Yeah, so this one we ran completely different. We were not. My co-founder Phil Daniels and I, neither one had raised investment capital prior to starting this business, so it was a big learning curve for both of us. I thought that it's not as simple as just networking or showing up at a pitch conference. I mean, there really is a lot of science that goes behind putting together a proper marriage. I mean, that's really what it is. Mm-hmm. So when we approached the Series B, we looked at it almost a year, literally over a year in advance, and we took a very methodical approach. The folks that know me know that I can be very analytical and I like to be able to do a lot of an analysis. Although I move fast as an entrepreneur, there are some things that you just need to take time on. So we took a year and we looked at every major deal that was happening. We connected to every association, every blog that was, and every is probably a strong statement, but most of the major blogs, anything that was associated with our industry. And we wanted to see over that period of a year, what are the trends happening? What are the numbers falling out? We looked at it both from an investor perspective, what would an investor look for in a potential investment, but then also, what are we looking for in a potential partner? And so deal structures, valuations, ARR, momentum, all the various things that go into there's that thinking pattern around looking for the VC. So then we listed out our 11 highest criteria. So this is an actual matrix that we have, and I'd be happy to send this to you. There's a whole scoring matrix that we created, and I could try pull it up here and go through some of the high level ones that we did, but probably not surprisingly at this point in the call, I can share that valuation was number 7 out of 11.
Very
so
interesting.
it was not the highest for us. While that's a major factor, obviously in dilution, it wasn't our number one factor. We cared about who the board members were going to be sitting beside us, that I could pick up the phone call or text at any given time, that were going to support us. We wanted to look at value creation, meaning how many dollars through either connections or relationships or even through the portfolio companies could drive additional revenue for our organization. Those were big things for us.
How are you figuring that out? I love this metric or criteria. How are you really figuring that out? It seems like a hard one to extract. Yeah.
Oh, I don't think so. I mean, no. Unless the portfolio companies or the VC companies don't list their portfolio companies, you can go to any major VC and look at who their portfolio is.
Yeah.
So you can look at trends in who they're investing in, what they find exciting, who their new managing partners are, listen to their blogs. You can watch their Twitter accounts. There's a lot of just simple hard work that's salesperson-ish that just go research them.
Hey, Rod, your video turned off. Did you accidentally hit the video? There you
go. Oh, there you go.
No, salesperson work. I like that. Okay, keep going. So what other criteria were on that list? This is pretty interesting.
So we did look at the portfolio companies. That was a big one for us to see not just who they're investing in, because so we took at let's just talk about the portfolio companies specifically. That told us, do they have knowledge of our industry or is it tertiary? So for us, we're in the healthcare space. So those that don't know healthcare might say, oh, okay, well, if there's a portfolio company that's investing in hospitals, then they're really close. Not at all. For us, we're dealing with employers. So if the VC is interested in hospitals, that's a completely different industry. Although it's healthcare, completely different industry. So we looked for patterns in their investment that would be similar to companies that we want to partner with. We also look for portfolio companies that we may be able to do business with. So that's a different lens. And from that perspective, it was who are the folks that we think we may want to do business with or could do business with. We might even have a cousin type relationship with that we're going after the same markets that we can trade war stories with and help each other grow. And that's proven to be very helpful, post Series B in being very, very helpful. I can't get into the details there, but been very helpful for us in finding that proper marriage.
Absolutely. That's a really interesting approach. I've never heard this tip before, but studying potential investors, portfolio companies, and who could you do business with. I think that's pretty smart. You mentioned you took a year, studied this. You were studying what an investor would look for. So let's touch on that for a minute. Did you have a pretty good sense of what your metrics needed to be for that Series B? Did you say when we hit certain MRRs, when we'll kick this thing off? Give me that side of the equation.
Yeah, so that could go into a whole different blog on making sure you establish a really good board. So we had a really good board that we were working with, and the board helped us understand what they would be looking for in a Series B. We did a lot of research on just what VCs think through, what are they considering. We worked with an outside entity to actually create a valuation deck, almost. It's this massive Excel spreadsheet that we created to think through what would we do if we were an investor. So IRRs, valuation today versus in the future, how much more dollars would you need, tacking in the pro forma data to kind of futurize, does this investment make sense today, and what would they use in argument. So that's probably far more metrics driven than you're asking about, but we wanted to see it from both sides.
Yeah, no, that's smart. You don't have to give me your exact numbers, but what should a SaaS business in the healthcare space be looking to be doing in monthly revenue before raising a Series B? Do you have a range or a feel for that?
No, I think that's all personal based on the business. That's a lot of that's going to be determinate based on the industry. If you're insurance company, you're going to need higher capital reserves to be able to come to market. If you're a SaaS business and you are a developer and you can develop it on the so to speak in your garage, you're going to have different needs. I don't know that I could say a specific number there.
Okay.
That's just going to be dependent on the business itself.
That's okay. So you did all this research, which is really fascinating. How many investors ended up on your short list, target list? And, how long did it take to raise the Series B? What happened after the research was done when it was time to go raise? Give me some stories.
Yeah. So the initial Excel spreadsheet, which was a Google Sheets actually, ended up being 76. And so we took kind of a two sides of the funnel, very, very sales driven approach to the way that we tackled, our Series B. So we looked at two sides of the funnel in essence. Who could we add to the funnel ourselves? And then who does our board have access to that they can refer us into? And so we sat down with our board and actually went through and created this joint list to go after. And we evaluated the list and started to put a grading system in essence. And I did a four level grading system to say these are the A players, B players, and I call them level 1, 2, 3, and 4. And so 3s made it to the list. They were investors that we would talk to, and that was we'd add them to the list. They don't, from our opinion, either didn't have applicable knowledge, and they didn't have the ability to follow on, but they could be a good potential stair step in between. So they could almost be a bridge, but wouldn't be an ideal. Mm-hmm. A level 2 investor to us was someone that had one or the other. They either had the ability to follow on, but no applicable knowledge, or they had applicable knowledge, but no ability to follow on. And then a level 1 was someone that had both. So both strategic and financial investor. And that we just did it that simple. We just went through and rated each of them and came out with a list of 76 was the final number.
Very interesting. Did you start by pitching the level 3s almost to get some practice going with your pitch, or did you jump to your level 1s, your highest targets, or did you have any methodology to that, to who you talked to first?
Yeah, one of so I'll answer that, and I'm going to back up and actually answer or reveal something else that I think is just helpful. I don't want to miss this. So for anyone listening here, once you are in market doing business, there are tons of the BDRs that sit inside of these VC firms that their whole job is to go out and find you. And we were getting, like everybody else does, emails almost every week. I mean, or multiple per week. And so I saved all those. I saved them all. I made a folder in my Gmail account and just called it Series A and started to save those. So when we went to this stage of actually creating this process, we already had a whole list of these folks with the contact names. And
just to, for anyone not familiar, BDR is business development rep, usually like a associate or, sometimes a little more junior person that's out scouting for deals for the VCs. Sorry, go ahead. Just no. Sometimes people get stuck on something like, what is he talking about? Okay, keep going, please.
Yeah, sure. Yeah. So then we added the list of folks that our board members had connections with. So then we decided to create a very formal process. So we started all this work in March of 2017 and started to gather up our research. Our team, it was basically Phil Daniels and myself, we would go through and look at the list. We would find out who the partners are. We would do our investigative work, look on LinkedIn, look at their portfolio, look at their Twitter accounts, just doing research on who these people are so that we can make that right connection. Once we accumulated all those emails, we were hitting that summer time frame. And meanwhile, we're trying to grow the business and run the business, which we're had done. And we were doubled revenue again. And so we put together an executive summary. We had our board send out our executive summary, which is a 3-page, in essence, it was a deck, but it was a high-level overview that someone could look at almost in an infographic type way. And we had our board members send to their connections, and then we sent an email to our other connections on the day after Labor Day. So we started the day after Labor Day, this process. And we went in the email, we said, we're starting our Series B. Here are a couple quick bullet points of our success. Doubled revenue. We're now at over 1,000 employers on our platform, and said we're looking for quality partners to help us get to the next level. And sent the email out on post Labor Day, and then started to field responses from that. Great.
No, it's exciting. So did you kind of blast all 76 targets on the list the day after Labor Day, or did you stage it all? Or
it wasn't really staged. I mean, it wasn't. We didn't pick the ones and twos to go after first. It was the way I did it. It wasn't a blast. So I would look at.
It's the wrong phrase, but
I'm not going to mention a name, but I mean, So I'm literally, as I'm talking to you on video, I'm looking at the spreadsheet. So we would go through and pick John at VCA, and I knew something about John. John had either contacted me a few months ago or whatever, and I knew something about him. So I would write a personal note to John. I mean, these were all very personalized. This was not, shotgun approach. It was very, very personalized. Attaching that document saying, we'd love to have you involved if you're interested.
Cool. No, yeah, and blast is the wrong word because I always counsel founders to not do blast. So, but batch, maybe batch is the better phrase.
Yeah.
Okay, so great. So then, 76 targets. How many do you think? Give us a sense of the shape of your funnel. How many led to pitch meetings? How many got into due diligence? And then did you have a competitive closing process, or what happened next?
Sure. So I've been saying that 76 number, and now as I'm looking at the spreadsheet, just recollecting, when we started this process, the number was closer to 50. But as is normal, when you start this process, you start to get tertiary interest from others. And so the number ended up being 76, but it was around 50 when we started. So just to put that out there. Yep. We got a phone call or meeting with 99%. In fact, there's only 2 on this list that we didn't have a conversation with. So we had a very, very good success rate with at least getting a phone call with someone of meaning within that organization.
And I bet that's largely, obviously, at a good business, but also you did your research and you had a really qualified list, right? You weren't targeting folks who were irrelevant or not at your stage, not at your, I bet a large factor of that is related to all that research you did. Anyway, okay, cool. And then, so you started that in March, and then you really did the outreach in day after Labor Day, which is what, September, right?
Right.
And then how long did it take to finish this up? How long did you run?
So we had a verbal term sheets. We were starting to talk verbally around structure of a term sheet to kind of qualify that in late October. Mm-hmm. And as everyone knows, during that time frame, you start to head into Thanksgiving. So we were talking more formally the structure with about 8 firms on the structure of a deal heading into Thanksgiving. Mm-hmm. And we had a deal done we had multiple. We were very fortunate in our process. We've built a fantastic business, and we just have a great team here. And we were fortunate to have multiple parties interested in a deal, and we were able to syndicate with 2 folks that we chose out of the process.
Yeah, that's great. Did you have? So it sounds like a fairly competitive deal. And on this one, I'm showing Elevate Ventures, Echo Health, HealthQuest, and Lewis and Clark. Was one of those entities the lead and the rest followers, or do you have a co-lead, or what the deal look like?
We had multiple companies that wanted to lead. Uh-huh. So we did something that I was told later was a bit surprising. I didn't know this, so claim a stupidity or lack of knowledge or experience in the background to just try something. But we made a decision internally and with our board that we were going to pair two parties together, and those two parties didn't even know it. So I remember picking up the phone and calling HealthQuest and Echo Health Ventures and saying, who both wanted to lead, and saying, hey, we're interested in working with you. We really like what you bring to the table. And we did. I mean, both of these organizations are high quality, and in our scoring matrix, both scored at the top. So it's like a tie between the two of them. And said, all right, well, even in an ideal world, why not? Let's pair the two together and figure out if we can do a deal. And come to find out, they actually knew each other. They didn't know that they were working on a term sheets for us, but they were both open to structuring a deal, and it worked out very favorably for us.
So I'm thinking, like, I thought you were going to say, two of them enter the cage, one of them leaves, right, with the term sheet. But weren't you worried that they would collude and, I guess if you had other interested parties as the stalking horse or whatever that phrase is, maybe. But were you ever worried they would kind of collude and hammer you down on terms or valuation or anything?
Worried is a strong word. You go in with your ideal situation, and sometimes, one of the things I would encourage folks to think through, the scoring matrix helped us to think about a deal structure less emotional.
Yep.
And it's very easy during this process to get really emotional and excited about something, and your emotions often can betray you. And we found that we got real excited about a particular firm, and the more we got to know them, we went through our rating system. It was like, why are we so excited about these guys? They don't rate very well. They're not very friendly. They've got excellent. I mean, and I won't mention who it is, but they have an excellent portfolio, but we don't really like these guys. So why are we even talking to them? And so, both with HealthQuest and Echo, it's like, we really like these people. And on my scale, number 12 of our 12-point system is like them, fit, and personality. So for us, we wanted to like these people because they're going to be on my board. In essence, I'm hiring my own boss. Mm-hmm. Do I want to find people that I enjoy working with, or do I want to have people that are just, always down or at me? And we found great people through this process.
I'm surprised "do we like them" is that low on your list. That would be top of my list, I think.
So 12 is number one. So
Gotcha. Okay.
12 is that is the highest ranking. Number one is actually the lowest. Yeah. Sorry.
So a couple other quick questions. I'll let you get back to business. But what other than this rating system, which I would love to offer to the audience, that'd be amazing to see the template on that. What other ways did you screen these potential prospects? How did you do a lot of due diligence on them? Did you contact and talk to their portfolio founders? Other background things you did?
Yeah, pre-term sheets with all 8 of these firms, we were doing background checks and doing our research on success rate. We were looking at board structures, governance, did they follow on? How were the follow-on investments? Did they seek down rounds? All the structure that we could look at on various software that exists already in the marketplace. And then we did pick up the phone and talked with folks that we knew that were already in our network. To give us a better sense of what type of investor will these folks be. And in that landscape, there's VC friendly and there's entrepreneur friendly. We were looking for someone from our standpoint that really understood our space and that would be more entrepreneurial friendly, but that can support us with a network of whatever it could be, problem set that we would find that'd be more network driven, more traditional VC.
Yeah. Totally. Good. This is great. So I think we'll just close it out here. With what one piece of advice would you give your younger self if you were doing it all over again? Or what piece of advice would you give, earlier stage founders, perhaps in Indianapolis, who are just starting out there, raising money and getting out there?
Sure. I think there's a common misconception, and this is one that we hear often in the Midwest, is that investment capital is hard to get in the Midwest. And while I will generally agree that it is easier to rub shoulders with VCs in pockets where there are more VCs, that's just logical. With a little bit of rolling up your sleeves and some hard work, most investors will have regions that they're going to want to take a look at, and it is harder for a West Coast investor to get over the mountain range and fly into the Midwest. Good businesses get funded. Yeah. So if you have a good business, if you are passionate and you can articulate that with great metrics, investors will come to you. But Midwest investors do have to work a little harder to actually get funding, because it's just not naturally someone I'm going to run into at dinner because they're somewhere else.
I'm here in San Francisco and I've been around this ecosystem for a while, and yeah, there are a ton of investors out there. But I always think of it like the equation, right? The denominator is much higher, but the numerator in terms of startups chasing those investors is equally as high. So it doesn't necessarily make it that much easier to raise money out here. It still can be hard, even if you're based in Silicon Valley. So, very good. Well, any call to action or plug you want to make for your company? Is there anything that you want viewers to check out, or employers if they're potential customers? Any plug?
Yeah, sure. I'll say a couple things. Healthcare in America is broken. It'd be hard to disagree there. Our centricity is around solving the employer problem, which is 50% of the healthcare costs in America is paid for, borne onto the employer, who only shifts about 25% of that cost onto the employee. So organizations that are involved in that ecosystem, we're really interested in just having conversation with. We may not be, you may not be a buyer, but there is an enormous opportunity to use software, to use data, technology, machine learning, all the massive things that we have moving, kind of toward using technology to solve healthcare. We'd say join us on that journey, whatever it may be. If you're building an app, or if you're looking for a job, if your startup didn't go well and you're looking for the next thing, we're looking to grow with extraordinary people so that we can build an exceptional product.
Awesome, great, and if they want to learn more, it's just springbuk.com, correct?
That's right, springbuk.com.
What's the name? What's the name from?
So a springbuk is a small gazelle. It's the third fastest land animal in the world. I've been to Africa several times, and they're fun and playful. When you think of data, healthcare, you don't think of fun and playful. And so a springbuk is agile. It's bouncy. It does this thing called pronging.
Sure.
It just kind of embodies who we are as a company. We're fun, playful, exciting, innovative, agile, not old and stale like a lot of the big data healthcare businesses are.
Yeah. It also makes me think of the Springboks. Is it the rugby team from South Africa?
Yes, it is. Yeah.
That's pretty cool. I like that movie was it Matt Damon? I don't know. Anyway.
Yeah.
That was pretty awesome. All right. Thank you very much, Rod. This is great. And I appreciate your time and good luck with Springbuk. Wish you success.
All right. Thanks. I'm happy to share that Excel spreadsheet with you, the matrix. So I'll email you that offline.
Yeah, we'll put it up as a link in the podcast. So that'd be great. Appreciate it very much.
Great. Thank you.
Thank you, sir. Bye.